Welcome student to the series of lectures on CFA and FRM preparation. And this series of lecture is on currency and currency hedging. And today we'll discuss about how we can perform currency hedging with the help of options. Yes, there are different strategy that we can apply in the options with the help of options to hedge a currency risk. And there are different strategy that you can see on the screen. I have written protective put. I have written buying out of the money put option. I have written collar. I have written put spread. I have written Seagull. Right. So these are the different strategy that you can apply to hedge your risk of currency with the help of option. But first of all, let's start with the basic. If I'm saying that you're buying a call option on a currency, what does it mean? So assume this is the FX rate USD INR, and I'm saying I'm buying a call option to buy INR. I'm buying a call option. So I'm a call option buyer for INR. But at the same time, I'm the put option buyer. What? Put option buyer for USD. So here I have a right to buy INR and I have a right to sell USD. So therefore it would be what? Right to sell would be put and right to buy would be call. Similarly, if I say that I have a put option or I have bought a put option on INR, which means I have a right to sell INR, which means I have a right to buy USD, and therefore I'm a call option buyer for USD. So whenever you enter as a call option buyer of one of the currency in exchange in FX market, then you will become a put option buyer. If you enter as a call option seller, then eventually you become as a put option seller for other currency in the FX market. Okay. So this is the basic and it is important. Okay. Now we are not here to study options. We are here to study that how we can hedge our currency risk with the help of options. Whenever you try to hedge any risk, whether it is the risk of stock, risk of bond, interest rate risk, currency risk, inflation risk, whatever you're trying to hedge, whenever you try to hedge, you have to think of two things. One is the hedging cost, and another is opportunity cost. Hedging cost is the price that you pay to hedge, and the opportunity cost is what you lose when you hedge. So there is always a trade-off between, or there is always a balance that you have to maintain between hedging cost and opportunity cost. You will understand opportunity cost better as we'll deal with more example. So first of all, let's take an example. You have a lot of USD position. Say you have 100 USD position and you're afraid that USD will depreciate. USD will depreciate and currently you bought 100 USD position at 80 INR. That is the exchange rate right now. So let's see that what will happen if you enter into a forward market. If you enter into a forward market or a future market, and specifically forward market, then there is no transaction cost at the initiation of the contract. So you don't have to pay anything. So there is no hedging cost, as in you're not paying any premium. You're not paying any margin amount because it is a forward contract, right? So there is no hedging cost. So why not to go for a forward contract? That is what we are trying to understand here. So if you enter into a forward contract, which says that you have the right to sell USD or you can sell USD. Actually, there is an obligation to sell USD. In a forward contract, both the party has an obligation and you have an obligation to sell USD at 80 INR. If you see very clearly, if you see properly, then you have actually hedged your downside risk. So for example, in future, say after 1 year or 3 months or whatever, if this USD depreciate and fall to 70 INR, and if you have entered into the forward contract, then because of this forward contract, you have a right to sell USD. Actually, you have an obligation to sell USD at 80 INR. And the other counterparty or the counterparty has the obligation to buy USD at 80 INR, right? So actually, there is no risk. So you will not incur the loss of 10 INR because you can sell USD at 80 INR in this forward contract. So what is the problem here? The problem is because you have entered into a forward contract where you have an obligation to sell USD at 80 INR. See what will happen if actually USD appreciate and go to 100 INR. Still you have an obligation to sell USD at what? 80 INR. So what you lost? You lost the opportunity cost. You lost the upside possibility in a very simple term. That is called as opportunity cost. Yes, you have hedged your risk, your downfall risk, but you lost whatever you could have earned if you haven't hedged this position. So whenever you hedge, you have to think in two terms, opportunity cost and hedging cost. Okay. So even if USD would have appreciated from 80 to 90 INR, you will lose on 10 INR. That is your opportunity cost. Now the question is how we can hedge. How we can hedge without losing opportunity cost. And there comes the option contract. Because in the option contract, you will hedge your risk, but you will not lose on opportunity cost. But you will start incurring hedging cost. Why? Because any option contract that you buy, you incur what? The cost of buying the option, that is the option premium. Okay. So this will lead to a hedging cost. What will lead to hedging cost? The option premium will lead to hedging cost. So what we are saying that if you enter into forward contract, there is no hedging cost, but there is a lot of opportunity cost because you have an obligation to buy or sell. So you lose what? Opportunity or the potential upside or potential profit. But if you want to enjoy the opportunity cost or if you want to enjoy the upside potential, you can enter into option contract. But as you enter into option contract, there is a hedging cost. Now, in the option contract, how you can play with this hedging cost, which is associated to premium, that is the all game that you have to understand in this lecture. And that's why there are different kind of strategy. So why different kind of strategy? The different kind of strategy has a motive to reduce the hedging cost, but at the same time enjoy the opportunity cost. And yes, you cannot do both at the same time. So what is the game? The game is to reduce the hedging cost. Why we are so critical about hedging cost? We are critical about hedging cost because in option, you will increase the hedging cost if you compare to the forward contract because there is premium. Okay. So assume there is an investor and he hold 100 USD. Current quotation, current quotation is 80 INR per USD. Now you have to hedge without losing on upside potential. So you have to hedge without losing on the opportunity cost. So how can you do that? A very simple answer is if you have 100 USD, then go for the put option. Put option at what? Put option at 80 INR. So you will have a right to sell USD at 80 INR. So you buy a put option at 80 INR. 80 INR is the current FX rate of 1 USD. So actually, you are buying at the money put option. You already have what USD? 100 USD. You can buy put option on 100 USD at 80 INR. So you have the underlying asset and you are buying the put option. Doesn't it sound like a protective put? Yes, it is a protective put. And the put that you're buying is at the money put. So this is the strategy number one. But what is the problem with this strategy? Actually, first of all, let's talk about what is the benefit of the strategy. The benefit of the strategy that if USD depreciate from 80, if it goes to 75 INR, you can still sell your USD at 80 INR because in put option you have a right to sell at 80, right? But not an obligation. However, if USD goes to 90 INR, you don't have an obligation to sell in put. Therefore, you can enjoy the upside and sell the USD in the market at 90 INR. So you're enjoying the upside and you're hedged to the downside. But there is a cost. The cost is high because you're buying at the money put option. The premium could be like 10 USD or 10 INR, whatever. It could be 10 INR. Don't take USD, 10 INR because it is at the money. Yes, definitely it is not as costly as in the money call option or in the money put option, but it is costly. Now the question is, now the game is how you can reduce the premium cost. And that's why different strategy. So we started with the protective put. Now the simple answer to this question is you can simply go for out of the money put option. Instead of buying a put at 80, you could have bought the put at 70 or 60. Definitely the premium will decrease drastically. And yes, I have given some information that the delta of the put for at the money is zero point 0.5 negative. For out of the money, it start decreasing, say 0.35 or 0.25. And for further out of the money, the delta is very near to zero. This is not relevant for this discussion. But you can see that if you want to reduce your hedging cost, you can buy out of the money put option. But there is a problem. The problem is, for example, instead of paying a premium of 10, you want to only pay the premium of 5, then you would have bought a put option of 70. So the hedging starts at 70 because you have a right to sell at 70. What if 1 USD falls to 75? There is no hedging. And because there is no hedging, you will incur a loss of what? 5 INR. What if 1 USD fall to what? 71? Still a loss of 9 INR per USD, right? And because you have 100 USD, then 900 INR loss you have to incur. So yes, you have reduced your hedging cost from 10 to 5. Yes, you have reduced your hedging cost because you're buying out of the money put option, but you have exposed yourself to some of the downside risk. Till 70, till 10 INR, you have to incur the losses. Yes, after that, the 70 put out of the money, 70 exercise price put will hedge you. Agreed. But from 80 to 70, you have to bear that cost. Now, this is a simple way of reducing the hedging cost. Now, they are asking the question. If you remember, or if you have a bit of knowledge about the bull call, they're asking the same question that we used to ask in bull call spread. They're asking, okay, you want to enjoy the upside that USD can increase from 80 INR can go to 100 INR or maybe 200 INR. But the question is, will that happen in the near future? You have a 3 month obligation to hold this 100 USD. Will in 3 months, 80 INR for 1 USD will go to 90 INR or 95 INR? No. The maximum in your head, you can say that it can go to 90 INR, not beyond that. Not beyond that. Okay. So for 90 INR, you can simply sell the call. I'm selling the call because if I sell the call at 90 INR, then I'll receive the premium back because I'm selling the option. If you sell the option, you receive the premium. So you're receiving the premium. See, the premium is only, say, 2.5 INR. No problem. But you're receiving a premium. And at the same time, you're buying a put option which had a premium of 5 INR, which you have to pay. So it is an outflow because you're buying a put option. Here you're selling a call option, right? In total, you haven't incurred a hedging cost of 5 INR, which was the earlier cost when you're buying only a put option and out of the money put option. Now it has reduced from 5 INR to 2.5 INR only. Okay. And this is a very famous strategy to sell a call. Sell a call. Again, it is out of the money call, not at the money call. Out of the money call. And you are buying put again out of the money, right? This is called as collar strategy. This is called as collar strategy to hedge currency risk and to hedge currency risk in a way that you enjoy the upside, but limited upside, and you hedge your risk through a way that you have reduced your hedging cost as well. So this is a collar strategy. Now, what is next? Next is a simple put spread. A simple put spread is saying that, okay, currently 1 USD is equal to 80 INR, and you're afraid that it will fall to 79, 78, 77, 76. Go and buy a put, which is at the money put. But you know that it will not decrease beyond 65 INR. So sell a put and receive a premium because you're selling a put. You're not buying a put. So you'll receive a premium. Say here the premium was 10 INR. Here the premium would be like, say, 3 INR. So the net cost would be only of 7 INR. Or you could have done that. Okay, currently 1 USD is 80 INR. I know that I'm afraid that if put falls beyond 70, I can actually bear the risk of 10 INR. But after 70, it could be limitless, or after 70, it would be quite difficult. So I'll buy a put out of the money and I'll sell a put at 60 INR. So I'll receive a premium. Okay. Now, the problem in this is that you have to bear some of the downside risk. But both the strategy is called as put spread strategy. It is up to you how much risk averse you are, which risk you want to bear. You can also have a combination of caller, where you're selling a call and you're buying a put, plus a put spread, where you're buying a put and selling a put. What was put spread? Buying a put, selling a put. What was caller? Selling a call, buying a put. So I can have all the three. I will sell a call, which is out of the money, because I know that 1 USD will not go beyond 90 INR in 3 months. So I'll sell a call. Then I'm worried if it fall beyond 75. So I'll buy a put. To further reduce the cost of the hedging, I will sell the put again because I know it will not go beyond 65. So I'll receive money from here, positive cash inflow. There would be a negative cash inflow and there would be a positive cash inflow. In net, my hedging cost will reduce. And yes, you can have different strategies to hedge your currency risk. Okay. You can also study something like, can I have a delta neutral strategy in currency? Yes, you can. What is the best delta neutral strategy we can have? The best delta neutral strategy in the world is what? Straddle strategy. Is a straddle strategy where you buy a call at the money, you buy a put at the money. Delta here is zero point 0.5 positive, delta here is zero point 0.5 negative. If you're buying both, then delta is zero. And what is a straddle strategy? This is a straddle strategy. In the next lecture, we'll talk about the straddle strategy, but this is the payoff and the profit diagram of a straddle strategy. You buy a call and you buy a put. Because of the call, you enjoy the upside, right? And because of the put, you get hedged to the downside, right? However, this strategy is the best strategy if you want your delta to be zero, which means that if the INR or USD appreciate or depreciate, it should not impact you, but you enjoy on the volatility. Actually, if you want to enjoy on the volatility, because whether the stock price or underlying asset will go right direction or left direction, you will always have a profit. So if you want to incur profit, if you have an assumption that there would be a high volatility, you buy a straddle strategy. And at the same time, straddle strategy always have what? Delta equal to zero. If you have an assumption that the volatility is going to shrink or decrease, then you will sell a straddle strategy. So basically, you will sell a call, you will sell a put, and you enjoy the premium because the volatility is very low. So the underlying asset will not move. If you are afraid of buying a straddle strategy because of high premium of at the money call and at the money put, you can also go for strangle, right? For strangle, where you buy out of the money call and out of the money put, and you still enjoy the high volatility, and still your delta would be what? Zero, because you will buy a call which is out of the money where the delta would be 0.4 and out of the money put where the delta would be negative 0.4. So the net delta by buying a call and put is going to be zero. But if the underlying asset, which could be currency or stock, moves a lot, then if it moves in this direction or this direction, you enjoy a lot of profit. And at the same time, the premium that you pay is very less. Okay. So what I'm trying to highlight that you can play with different combination of call and put and enjoy the hedging, enjoy the upside movement or upside potential or opportunity cost. But you need to ask the question that which cost you are ready to bear and which cost you are not ready to bear. And then you will apply the different combination of call input. With that, I'll pause here. Thank you. Have a nice day.